We're going to keep it on the markets and bring in our next guest. Kevin Flanagan is WisdomTree head of fixed income strategy. Kevin, thanks so much for joining us today. I want to start off with Fed testimony and what Powell had to say. Do you perceive his comments as perhaps being slightly less hawkish, a little bit more dovish at this point?
Yeah, to a very, very small extent. I think, the markets have been waiting to hear from the chairman for quite some time now with all of the various news headlines that we've had, markets pricing in 7 rate hikes, 50 basis points move for March. So it was nice to actually hear from the chairman himself. And I think what's more important is that he knew the markets would be focusing very intently on his wording. So for him to say he is inclined for 25 basis points in March, we should take that for what it's worth, for sure.
So how many rate hikes do you see coming during the year? And then what about his comments as far as tightening and running off the balance sheet? Is that more or less in line with expectations, do you think?
Yeah, I think at this stage of the game, even with the unfortunate news of what's happening with Ukraine and the Russia-Ukraine crisis, I still think the Fed is where we should be staying focused, the Fed and inflation. So I could see the Fed front loading here and raising rates at the March, May, June, and July meetings, perhaps for a total of 100 basis points. And then they move to their balance sheet in the second half of the year. Remember, a runoff of their balance sheet is akin to another quarter point rate hike. So maybe that's how you get to 5, 6 rate hikes or so, some the traditional way and some via the balance sheet.
I'm wondering how fine a line do you think the Fed is walking right now, hiking into higher energy? Inflation is soaring. How worried are you that they actually stick the landing? They just said, Fed Chair Jay Powell said that they can stick the landing, but how concerned are you about stagflation and potentially recession?
Stagflation, I don't think is really on the radar. I think, if you're to break the word apart, the inflation part, I think that's going to continue to remain sticky. It's going to be difficult for the Fed to bring inflation down any time in the near term. There's only so much they're going to be able to do by raising rates, as we were just discussing, even their balance sheet. On the stag side, I think the good news is that the Omicron variant really did not hit the economy as some were expecting. So we're actually, I think, in a better position moving forward, as one would have not maybe anticipated if we were having this discussion a couple of months ago. So I think we can have nice solid growth. Let's call it maybe in the area of 3% or so, but it's that inflation part that's going to remain sticky.
There's been a monster bid into bonds recently. I mean, today yields are higher, but what do you make from the yields? What are you signaling? What does it signal to you, and where do you think they go from here?
Well, this week's plunge in yields was really, I think, a function of the news over the weekend. From what we saw with Russia being removed from the SWIFT system and some of the other kind of financial sanctions on the central bank in Russia, that there's concerns at any point, whether it was the financial crisis, March 2020, when COVID first created the lockdowns, there's concerns about the funding markets. Are our firms, our banks going to be able to fund themselves? And we really have not seen any kind of red or even yellow signals showing up in those markets of yet. But there was enough caution involved that it was kind of a student body right mentality, flight to quality into bonds. And now, we come back, staying focused again, right? We come back to the Fed, to inflation, Powell speaking. And the next thing you have, as you just pointed out, a 10-year Treasury yield up 15 basis points today. So I think that's the direction. A sawtooth pattern, volatility, but we still feel rates are going to continue to move higher later this year.
And what are you hearing as far as concerns from your clients, and what are you advising them as to means to sort of protect their portfolio at this time?
Yeah, well, I mean, the focus has been on rate hedging. Rising rates has been our primary theme for quite some time now. And when the chairman of the Federal Reserve basically tells you he's going to raise rates 25 basis points, we should listen, right? It's not often that you get the Fed chair actually sort of laying it out as to what is going to occur. So, what we've been doing is talking about a Treasury floating rate strategy, where you have Treasury floating rate notes that are 100% Treasuries They adjust every week with the weekly 3-month T-bill auction, and it's a nice complement for the core part of your bond portfolio. And there's no credit aspect, right? There's other instruments that can have credit or concentration in financials. This is 100% Treasury. So as the Fed raises rates, this should continue to move and adjust and float higher accordingly. And the duration is 1 week.
And Kevin, what's your take? I'm interested to learn about the energy issues that are happening right now, and news that OPEC Plus will keep output steady, 400,000 barrels to be put out in April, no more, despite a conflict that's going on. And then, of course, the IEA releasing the 60 million barrels of oil from its reserves, just a drop in the bucket, really, equivalent to 6 days of Russian output. That's not going to do very much. One analyst saying that, if the number was 200 million barrels of oil, that might make a significant difference. Do you think that we need to be drilling more in this country at this point?
Well, that's certainly going to be the argument from the Republican side of the aisle that we've begun to hear already. I'm not quite sure the Biden administration has moved into that camp yet. But what we're seeing, obviously, with respect to energy prices, it hits home. And it's something that obviously was mentioned in the State of the Union address as well. And that's something the Fed can't really do, or a central bank really do anything about, right? Higher energy prices. And the question becomes, is it inflationary, or is it more of a tax on the consumer? I think as long as we continue to have it moving forward and not being a significant tax on the consumer, it's status quo. I think if we get to the point where it begins to affect economic growth here at home, perhaps then you see the Biden administration maybe consider other aspects on how to increase production here at home.
Well, investors are definitely taking it all into stride today because the benchmarks are at session highs at the moment. We'll have to leave it there. Kevin Flanagan, WisdomTree, head of fixed income strategy. Thanks so much for your perspective today.